So as we talk, the markets are in a bit of a free fall. Some might say it's a bear market, a correction, but whatever you call it, it seems to be something different than we've seen the last couple of years. So are you very worried that this is the beginning of a path towards a recession?
Yes, absolutely. I think it's interesting because I was reflecting on this the other day that whenever I start a new job, it's right before a big financial crisis. I started at Yale Investments Office right during the Russian bond default and the long-term capital. I started at Bowdoin, my previous job, in July 2000, right before the dot-com crash. And I just started 9 months ago at Rockefeller. So I think there's a pattern here. I originally thought it was going to be short-term because of the whole COVID and the supply chain issues and all of that. But then you have Ukraine, you have the Fed, you have inflation, which I thought was temporary, but now I think it's very much a long-term thing. And I do think we're in a bear market, which makes me manage a portfolio very differently than if we were in the, in the bear, in the bull market. We could have, anyone could make money in that, but this is going to be a harder time to generate returns for Rockefeller.
So for Rockefeller and many other nonprofit organizations, they had a spectacular year last year. They had, returns of 40, 50, 60% annualized rates of return. Do you think some of those returns are going to be coming back because now some of the great venture funds they were in are now going to have lower valuations?
Yeah, I think last year at Bowdoin, when I left in June, the fiscal year return was 59%. You had Washington University, which was in the 60s. These were once in a lifetime returns. A lot of it was driven by venture capital. Some venture capital on a dollar weighted basis were up over 100% over the 12 months ending in June. I don't think that's repeatable. It was an incredible period of time. I just had an investment committee for Rockefeller University this week. One of the questions was, what are the real marks on these private investments? As you know, private investments are lagged in valuations. And I think it's going to be this gradual write-down of these assets. I still believe in alternative markets, and I think there's going to be two problems for endowments. One, a lot of endowments use a smoothing rule for their spending. They use a 12-quarter moving average. Well, you're having all these great quarters, and so if you use that, take 5% of a 12-quarter moving average, you're going to be overspending. The other problem is going to be asset allocation. As the public market goes down, and the private alternative assets aren't marked to market, you're going to be way overweight in your private. And that brings up liquidity issues as well. And so right now, I think institutions need to be very prudent, focusing on liquidity, dry powder. It's a time to protect capital, not to shoot the lights out to get some great return. Right now we're in, I do think we're going into a recession, and that's a totally different playbook.
So let's have some optimistic news. Anything good about the economy you can think of?
Yeah, no, I believe into the entrepreneurship and the creativity of America. I think that there's some wonderful creativity that you have young people who are concerned about the environment and they're, working on different things. I do think that eventually I believe in capital markets and I believe in equities for the long run. And I do believe that are going to be some things that way overshoot and there are going to be opportunities for skilled investors. I also think that as Warren Buffett said, when the tide goes down, you see who has bathing suits on. I think we're going to see a lot of that, but there are going to be some great opportunities that come for this. But you have to be patient, and you also have to think creatively, I think.